Aggressive valuations. How can you be sure that you are not picking stocks that are in a bubble? How can you be sure that you're not paying a high price? So, Benjamin Graham shares with us in this book a general approach, 10 steps, in which we can have an independent analysis of a given stock and a security. So, what are that? The first step is to read at least 5 years of financial reports, the annual reports, quarterly reports, proxy statements. Then we should be able to describe a business that we are trying to pick. The customers, how does the business grow, what are the solutions provided by the business. So you should have a good understanding of the business, at least on a high level. Then summarize the operating results, look at some of the financial metrics in the annual report, in the quarterly report. What are the revenues? What are the profits look like? What are the margins for profits, etc. Then evaluate the financial health. What are the strengths and weaknesses? What kind of cash do they have? What kind of assets, liabilities do they have? Do they have a growth record for dividend payout increase? Do they give dividends? Is their earnings growing? Then have future possibilities that you can postulate. Some sort of a vision is needed for you to win big in stock market. You should be able to anticipate some amount of future, the growth of the company, and also potentially the competition that the company that you're picking will face. If you cannot do that, then you cannot expect to get any more return than the index return. Um, so also with that future possibilities, you need to have a good understanding of the moat of the company. Does this company have a near monopoly? Does this have a good brand? Does it have a good franchise? Is the business easy to understand? All of that is what constitutes a good moat. You want to buy a company which has a good moat, which future earnings are going to be protected. Otherwise, there's going to be competition to take away all the business. Find out if the company is a marathoner or a sprinter. Is it something that that you like to be a sprinting company or a marathon company? List out all of your assumptions when you do this analysis. Evaluate the soundness of management. Look at the CEO pay. Look at who are those executives. How long have they been in there? What is their track record? What big changes have they done? What recent changes, if there is a new CEO, have they done? Is it still in the cleanup phase, or is it now in turmoil because everyone's leaving? Find out the soundness of management. Do they keep acquiring companies and not have any internal way of growing products, or are they innovative? Find out the soundness of management is a huge role to play. And then check if you have a margin of safety. Are you paying a full price for a stock which you expect to grow 3 times, but you're already paying the price right now? Then the company's earnings may grow, but you're already paying a very high price right now. So you don't have a high margin of safety. Ideally, you want to buy 60 cents dollars, meaning you're buying a dollar worth of share at a 60 cent. You typically do that when there is some sort of a bad news that you know is temporary. You know the company has been doing really well, but the market is irrational at this time. So that's when you can get to a 60 cents to a dollar. Understand some sort of a macroeconomic growth, like how is the country doing? Is the GDP increasing? Is the inflation under control? Are the jobs market stable? The commodity prices, risks associated that you can foresee for the business and for the company itself where it's operating. And finally, the last thing, you want to have some sort of an opinion on the attractiveness, ideally in 12-month period, not like 5 years into the future, because it's too difficult to predict that far into the future. So once you do these 10 steps, you can create a document which analyzes a given company. Before you do all of these steps, just picking a stock is too naive. You'll probably most likely lose a lot of money. It appears, according to Benjamin Graham, it appears to be almost impossible to distinguish in advance between those individual forecasts which can be relied upon and those which are subject to large chance of error. So Benjamin Graham has like 40 plus years of studying the industry, and even he's saying it's very difficult to find out which forecast to look at. So And he also says simple algebra is the best what is needed for a stock market analyst. And he's saying that at max you will need simple arithmetic and elementary algebra. So what this leads to the conclusion is that you are better off creating your own forecasts, your own comparison, like this one in the book. You take the 4 companies that you're interested in, you list down the capitalization, the earnings, the balance sheet, the valuation, and you do your own analysis. You can definitely read some of these forecasts from other companies, but there's no clear way in which you can say, hey, this is a reliable one based on Benjamin Graham's 40 plus years of studying the market at that time. So also remember, studies of these kind can go in so much detail. Let's take an example. In this case, we are comparing these 4 companies from the textbook. He's looking at how is the company capitalized, what is the total return, what is the stock price being paid, what is the market capitalization, what is the total debt of the company, what is the revenues, and what's the net income. Eventually calculating earnings per share, and then balance sheet, like what are the assets, what are the liabilities, what are the book value. And there are these 2 important metrics: price to earnings, price to book, and net income over revenue, which is some sort of a profitability margin. And there are at least 20 different ratios that you can come up with, like return on capital, how much income per book value. And if you look at all of the other 10 ideas that were brought up, this kind of study can go into so much detail. We'll also have to discount the PE based on accounting issues. So there is a lot of caution, but only when you have a vision for some company that you can actually get the profit of having that vision being sound and you betting on that vision. But if you take a lower risk approach, like the index, then you're probably diversifying in a pretty big way. So you're reducing your risk, but at the same time, you're reducing your opportunities for big returns. Many things can happen on top of this, like you could do field trips, you can do interviews with the research people at the company, etc., etc. And you can take a long time to just analyze one company. Even employees at a given company have a very hard time to understand how their company works. But now if you have to understand outside companies, it can be a lot of work. And so at best, you could make it simple. You could create your own Excel sheet and compare some of these companies, ideally in the same industries, with a certain same level of assumptions. Predicting the market as a whole, and then the industry sectors within the market, and then the specific stocks in those industries, the odds that the individual investor can do any better are not as good as those people who are doing this full time, who have a lot of resources, a lot of time, capacity, ability to do ground interviews, individual research. It's very, very rare that an individual investor who's picking stocks will make money, especially if they're doing it as a defensive investor in part-time aggressive capacity. Most likely the chance of losing money are very high. So to ensure that we are not picking stocks that are in a bubble, again, let's do a quick recap. We did some of these numbers in the previous video, but the market capitalization for a defensive or a lay investor should be only companies that are slightly bigger in market cap, at least $2 billion, ideally $20 billion. The assets over liability, the current ratio should be greater than 1, ideally greater than 2. So that means the company has more than what it owes. Very simple math. Price to earnings should be less than 15. The earnings, not the forward-looking earnings, but the last 3 years of average earnings. So typically most companies give forward-looking earnings, so you should look at the last 3 years. At max should be less than 20. So we have a video on price to earnings, so you should be aware of the accounting changes as well to have a right price to earnings. Earnings per share is a good metric to find out if it's growing over time. Check if there are fluctuations. It should have a stable earnings per share increase over time, and same for dividends. Ideally, it's increased at least 50% over the last 10 years, which is compounding almost at the rate of 7%, 5 to 7%. And if it's better than the index or not, that's something you have to check. And for this, what you could do is you could do a test drive. for a year, spend understanding the company, make hypothetical trades, check if you are doing a diligent work into understanding those companies, and then eventually move from earnings per share to return on invested capital, which is basically take out all of those stock options as part of income, and then invested capital, take out all of the cash, and actually do ROIC calculation instead of earnings per share. So once you do that, you'll get a better understanding of like, hey, if I'm an owner, I have invested this much money into this company. How much is it making me for the money that I have invested? Then price to book should be less than 1.5 ideally, but less than 2 for sure. It basically is telling you like what multiple is this company trading at for the price that you're trying to pay. Net income over the revenue gives you the profitability margin as to what is the margin. And if you see the profits increasing but the margins going down, that means there's a problem. So it's got to be some way in which the profitability margins stay healthy and improve actually over time because of scale. Dividend growth with earnings should be at least increasing over the last 10 years. Price to earnings, price to book, that ratio, the Graham numbers is what is called P by PB, should be less than 22.5. So basically this is under the assumption that 15 is the price to earnings and price to book is 1.5. If you multiply the two, you get 22.5. But even if you do 20 of price to earnings, then it should be less than 30. So just check for this validity of some of your stocks. You've got to be able to do your homework. You got to be able to practice before you actually buy stocks, make hypothetical trades, spend a year investing in the index fund, and then hypothetical 10% of your time, or 10% of your, not 10% of your time, 10% of your fund is in stocks that you pick, but after a year of actually having picked them, and then check if you did better than the index. If you didn't do better than the index, and if you didn't do better than some of the mutual funds, you're better off not doing your own stock picking. But at least now you traded without making any real trades. You just made hypothetical entries and you're checking which companies you're buying. If you don't have the time to read 5 years at least of some of these annual reports, quarterly reports, you're not in the right place of picking stock. You shouldn't be picking stocks. Learn from similar-minded mutual fund pickers. You can easily find out which stocks you picked are being picked by other investors or big mutual fund houses. You can follow them. You can follow their analysis. You can follow their commentary. Learn from them. And ideally, you start all of this work after you've built a very strong base of an index, which is index fund in your portfolio, which is almost 90%, especially if you're a defensive or a lay investor. And with the discipline and consistency, you can actually get some of these high-performing results. But the probability, as so far we've learned in the last 15 videos, is that it's very low. So you should check for yourself, test drive, and only then get in. Thanks.